Seems to be a beat across the board. A couple, just maybe one moment of weakness in the M&A department. If you could just give me kind of the broad overview of what you guys saw in the second quarter.
Sure. Well, it was an interesting quarter, certainly with the start in April. But really across our businesses, we fought through that environment, obviously focused on supporting clients, and feel good about the revenue momentum continuing in our businesses, delivery against the ratio targets that we set out for this year. And you're right, that was an interesting environment. There was some volatility in the markets, obviously, that you needed to trade through. Corporate activity has clearly been chilled by the environment, the uncertainties around trade negotiations and what have you. And so we're seeing that a little bit in our corporate bank and also, as you mentioned, in the corporate finance wallet, where we're down year on year, reflecting really how we index, sort of where our strengths are and where the activity was in the quarter. We're still sort of optimistic about the path ahead for that business, but that was one area of relative weakness.
And then looking at FIC, I think it was up 11%, beating kind of most of the estimates that we had there. I'd like to get kind of the topography, the texture of what did well within that. I think there was a bit of difficulty in the beginning. Did FX win out? Credit is something that others have been struggling with. What did it look like for you?
Well, FX was actually very strong. It was probably the strongest point, and macro generally, so rates as well. Although it was a complex quarter given the way it started. Credit was a little tougher in the environment, for sure. Our performance we're really happy with, a very strong finish to the quarter. And you have to remember in all our results that foreign exchange translation is a burden and a benefit for some of our competitors across the Atlantic.
And a strong finish to the quarter. Going into the third quarter, what are you seeing?
We're seeing good activity, good performance. Now, it's obviously early in the quarter to talk about it in July, but in terms of both the FIC business, fixed income and currencies, and our origination advisory business, good start to the quarter, and that gives us some real confidence about what lies ahead in the second half.
And what also may lie ahead is a buyback. I know it's sitting now with the ECB. Analysts are expecting something to the tune of about 400 million euros. Is that broadly in the right ballpark?
We can't comment on size, but we're pleased to be in the position to have submitted only a couple of months ago now the application to the ECB. There's a process that we go through, so we can't speak to size at the moment. But we were pleased to be in a place of incrementing the originally announced buyback and executing, in a sense, throughout the year.
And so your base case is to be able to deliver on that buyback by the end of this year?
Absolutely.
Okay. And in terms of tariffs, I'd like to get, we've been talking about tariffs for a while now.
We have.
I'd like to talk to you about the idea that, because you're talking about it's holding back corporates, right? But there's also this underlying kind of bullish sentiment within Germany, a lot of investment and a lot of private investment also coming in that we talked about a little bit earlier in the week. Is there a sense from you that there's a lot of pent-up business that's just sitting on the sidelines? Can you give us kind of an idea of what kind of volumes we're talking about and what it would mean for you?
There is. Hard to translate into volumes because it's a bit of a guess.
But in the event of a deal, do you see just a huge flow of
We do. It's so this uncertainty, it's fascinating talking to clients. The impact on any given client's business of the tariffs, whatever the arrangement will be, can be very varied, depending on the foreign content and what they sell in the United States, depending on where the manufacturing takes place, how much intellectual property, and the supply chain underneath it. So it's a very varied thing. But as a consequence, until people see sort of what the final agreement is, it's very hard to make investment decisions. And so that is absolutely holding people back. In Germany, we have and to an extent in Europe, given the sort of knock-on effect of German fiscal policy changes, we have an offsetting benefit that we have an investment wave in Europe coming. So everybody's sort of positioning for how am I going to participate in that investment wave or be a supplier into defense, infrastructure spending, sustainability, digitalization, all the things that in Europe we need to invest in. And that's definitely going to be an offset to whatever the headwinds are that come from the trade arrangements.
And then in terms of this sort of buy Europe trade, this is a theme that we've been talking about in the markets a lot. We picked up with it with Christian Zaving earlier in the week when he came in to speak with us. And he was talking about a large amount of client flows, a large amount of clients coming to Deutsche Bank, wanting more exposure to Europe, less to the United States. Can you give us some idea of what that actually looks like? Who are these clients? How much business are we talking about?
Well, it's in essentially every conversation that we have. Obviously, corporate clients, where they're going to invest and how they build for the future that's shaping up. But as you mentioned, institutional clients, where to invest money. I was, for example, had an extended trip to Australia earlier in the quarter, where all of the superannuation funds, looking at their allocation of investments around the world will say, well, we may be overexposed to the United States and think about reallocating to other parts of the world. And also, of course, hedging, looking at their currency hedges and what have you. Europe has a real opportunity to position itself as that alternative investment destination. Now, as we all know, there's a lot to do from a structural perspective, savings and investment union, making Europe as attractive as possible for the destination, but the interest is there.
Yeah. And in terms of, we're talking, volatility has been the theme for the conversation for a very long period of time here, whether it's tariffs. How destabilizing an event from your perspective and the clients you speak to would the firing of Jay Powell at the Federal Reserve be for markets?
Well, look, markets like confidence. They like confidence in institutions. They like predictability of policy. And so we would absolutely sign up for this idea that independence of central banks gives the markets confidence in the direction of monetary policy and what drives the decision-making of monetary policy. So in general, I don't want to talk about specific sort of arrangements. Anything that politicizes the determination of monetary policy is a source of uncertainty for the markets.
And another thing that's changed, kind of volatility, something that will see a lot of growth in Europe is the defense sector. It's something that you have positioned to sort of take advantage of. I'd like to get an idea from you of what sort of proportion of your business you think is going to be weighted more and more towards defense. How is that going to manifest itself in terms of your earnings?
Yeah, again, hard to dimension, to be fair, but it's across our business. So it's not just the lending portfolio, or not just the financing, underwriting, or advice that we do for these companies. It's a broad thing, but we think we're extremely well positioned. So we've been a large sort of lender and an advisor to defense and aerospace companies, consistently over the years. I think we have the relationships. We've organized ourselves with sort of cross-industry, cross-product teams now to make sure that we're serving these clients and across the spectrum. And to your point, not just focused on the corporate needs, but also on what investors are looking to finance in this industry. Not just public companies, but also private companies, innovation, supply chains, if you like. There's a lot to do.
Is it too early to talk about M&A in the sector? Is that something that you're seeing kind of boil up?
Specific ideas, too early. But the concept that Europe needs a smaller number of defense providers, a smaller number of platforms in particular, into which to concentrate its defense spending, I think we absolutely subscribe to. And of course, we will work to help advise and facilitate on those transactions as they come. And by the way, defense is also not always corporate mergers. It's quite a flexible industry in terms of how defense companies collaborate on specific projects.
And then another thing that we've been focused on is M&A slowing down there. It's also at a time when you've invested heavily in your origination and advisory business that's sort of retreated a bit. Is there going to be a consequence for that in terms of job cuts, or are you sort of committed to this as a sort of theme of coming back in the near future?
We're committed to our investments. Obviously, we want to be judicious about where we invest because we believe that there's a sort of a unique profile to where Deutsche Bank is positioned to sort of, idiosyncratically help our clients in a footprint that makes sense. But that investment was the right investment, we're convinced about. Obviously, the wallet recovering has taken longer than we might have thought. But these investments are long-term investments, and so we're quite confident that it's coming back.
And you've also made it sort of your priority recently, also talking about driving more shareholder value, sort of focusing things. What does that actually look like in terms of what you're thinking about? Does it matter? Does it trimming certain things? What does that kind of specifically
Well, look, it's a discipline that, by the way, is not new, but we've sort of built the infrastructure, if you like, to really be able to do this on a granular basis. And we've got the business leadership behind this idea of managing the company to shareholder value. And so it's across the board. It's what business you do with clients and which clients you serve. It's the pricing of the products. It's how we use the balance sheet and shape the balance sheet. It's what you choose not to do. And we've given some examples, for example, in the mortgage business where we've taken back, balance sheet. And so as it permeates all of our decisions, it really means that we can align the business we're doing for clients with the outcome for shareholders in terms of generating returns.
And you've had a little bit of time to sit with the announcement from the German government that they're unleashing the debt brake. We don't have the final figures of how much money is going to be spent, but do you have a clear idea of how much, for every $1 billion, let's say, that they spend, how much of that will in some way travel through Deutsche Bank or Deutsche Bank will facilitate?
Yes, I mean, but again, it's hard to dimension. One would hope pretty much everything, and insofar as, I mean, we're not going to, of course, have 100% market share,
right,
but we'll be involved in the issuance of the debt. We'll be involved in holding the accounts that the funds go to. We'll be involved in financing the corporations that build factories to supply it. We'll be involved in supporting the households that are the beneficiaries of the jobs that are created and the wealth that's created. We're supporting the investors that then put money to work, behind all that. So the point is it permeates our business, if you like, and so we'll see it in many dimensions in time. It'll obviously take time to build, but we're very sort of excited about the opportunity to represent.
Is it a good springboard to then look further afield and maybe look at expanding more outside of the German market? I think, of course, as always, M&A potentially across Europe. This is what, Mario Draghi would be very pleased by that.
Well, so in time, yes, but I think the first thing is it is strategically an opportunity for us to capture as much as possible of that opportunity. But to your point, to the extent that it sort of ripples around, the European economy and other countries, of course, and I think there is a generalized view, and you see this in a lot of discussions in the press and the industry. Europe would do well to have larger banks serving an integrated economy in a single banking market and capital markets union. And so yes, we absolutely subscribe to that and think it can be a spur towards that future.